about chart patterns and trend patterns and their interpretations. Now, in tonight's class, I've got actually three special little presentations I put together for you that'll help explain these patterns better than I do just with my little words. And if you'd like to see these little presentations at another time after class, you can do so by going to YouTube and looking for the YouTube channel that's called Traders Education. So just go to YouTube and search for, not a word search, but search for the channel that's called Traders Education, and then you'll see a playlist for chart patterns, and you'll be able to see in that playlist are all the little presentations I'm going to share with you tonight. Now, also in tonight's class, I'm going to intermix the terms: security, asset, I might say stocks, I might say bonds, I might say cryptocurrency, I might say Bitcoin, I might say the euro. I'm also going to show you some charts. But these are not specifics, because we're talking about concepts tonight that work in any charts for any publicly traded financial instrument in which an open market exists. So we're talking about tonight chart patterns interpretations for every different type of CD you can trade on the ETX platform. Similarly, I intermix the terms investing and trading. Now, we're all here because we're part of ETX, and therefore we're traders. But it gets very boring saying trading, trading, trading. So I mix up trading and investing. But we know the difference. Trading is short term, investing is much longer term. But it doesn't matter. The same concepts hold true there also. Now, I can't tell you how often when I'm giving seminars and presentations, the first thing people ask me is, what should I buy? What should I sell? Where will the prices be later today or tomorrow? Where will they be next week or next year? So wouldn't investing or trading be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board. I don't have a crystal ball. So if you're attending this class in the hopes that technical analysis and chart patterns fall into the field of technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, that I sure do promise you it will. Because trading is about finding opportunities and then filtering out those opportunities so that you end up with only high probability trades. And once you've filtered them all down, and then you drop it into your risk management and your money management schemes, at the end, when everything falls together and comes to place, you actually will have a trade. But what you're hoping for is out of 99 potential trades, they all get filtered out and you end up with one good solid trade. Because what you're doing is only trying to find the best trade to make. Because the market offers tons of trading opportunities. There's more than enough. So you want to get rid of all the high risk ones, all the risky ones, all the iffy ones, and hopefully end up with the best choice possible. Now, chart patterns fall into the field, like I mentioned just a minute ago, of technical analysis, because it refers to the study of financial markets based on price movement. It uses the assumption that the price of a share or an asset reflects all the information about that asset, including market sentiment as well as its perceived value. Now, charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in price. For instance, head and shoulders, channels, triangles, wedges, pennants, flags, head and cup and saucers. There's all types of double tops, triple tops, double bottoms, triple bottoms. Now, ultimately, we could call technical analysis simply chart analysis, because it involves everything and anything that we do on a price chart. Whether we're putting simple support and resistance lines on a chart, whether we're just looking at a price chart to see how price is moving, whether we're doing very complex things and adding Fibonacci retracements and adding all kinds of oscillators and indicators and dropping on chart patterns and using all kinds of things is all done on a chart. So we could simplify it all and call it all chart analysis. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Now, let's explain that a little bit better. Price only and always is only a reflection of the buyers and sellers in the market. So if price is a reflection of what buyers are willing to buy for, sellers are willing to sell for, it's all based on psychology. And the psychological effect give us specific patterns. When a market is panicking, when it's constricting, when it's getting ready to do something, these human nature will develop the same type of trading patterns. When we see these patterns or these pattern formations, we can then figure out what to do with them. Now, pattern formation do not form a trading system, but rather provide an indication of future price trends of an asset as price breaks key psychological barriers in the form of support and resistance. Now, there are numerous types of patterns, and these handful of patterns, and they're only a very specific handful. There's a lot of them, but this handful of patterns have been well documented, have been used for years and years and years and years and years, and they repeat themselves. And when they develop in a price chart, we can see historically, whenever we've seen an ascending triangle develop in an uptrend or a downtrend, this is what's going to happen. When we see a head and shoulders, this is going to happen. And this has happened historically over and over and over again. So the most prominent and most well-known pattern is called a triangle. Not complex. Now, there are three types of triangles. We have ascending, descending, and symmetrical triangles. And these all depend on simply the support and resistance lines that form the triangles. Price starts moving in up and down, up and down, up and down within, we don't have a triangle yet, but between these levels. And at some point, we can draw a support line underneath, and we can draw a support line, a resistance line above, and we'll see that price is forming this triangle, because what happened is the movement between the high and the low are getting tighter and tighter and tighter. So a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of a share or an asset. With a positive sloping support line, the price levels are squeezed into a corner. And this is what triangles are all about, is price getting squeezed into this corner. At some point, it's going to have to break out. Price is going to have to break out. So as price is moving into that apex, we know something has got to happen. Now, triangles do not predict direction. In fact, no chart patterns actually give us direction. They give us momentum. They give us, when it breaks out of the triangle, it gives us what we call a breakout, and it can break out upward or downward. But when it breaks out, as it's moving into this center point, this apex of the triangle, it's only got two choices. It can break upward or it can break downward. Okay. When it does, there are certain rules that we can apply. So once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. Now, there are specific variation of a triangle that can occur, namely ascending and descending triangles. An ascending triangle has a horizontal resistance line and a descending triangle has a horizontal support line. I don't personally differentiate. I see a triangle pattern. I can see whether it's coming off an uptrend or a downtrend. Okay. I don't differentiate and sit here, oh, that's an ascending, that's a symmetrical. All I see is a triangle. Because the rules are the same for whichever triangle it is. But they're usually formed, a descending triangle is usually formed during a downtrend, where an ascending triangle is usually formed during an uptrend. But the triangle formation doesn't tell you that that trend is over. It doesn't tell you the trend will continue until you get the breakout. So it's important to note that an ascending triangle also can be found in a downtrend. So the combination of the name of the triangle and the market trend is sometimes deceiving. Now, there are certain clues that we look for as price breaks out of the triangle. And the most important one is volume. Because you'll have false breakouts where price will break above the edge of the triangle, but go right back into the triangle. Or price breaks out, but doesn't go anywhere because there's no market conviction. What we're looking for is a verification of that breakout. And the first thing we look for is volume. Because the minute it breaks out, we should see volume increasing. And then we can start applying the rules of a triangle. So let me share with you a little presentation that'll explain this visually a little bit better than I am. And you might have to turn up your volume to hear this. Sometimes these little recorded presentations, the volume isn't as loud as when I'm speaking to you. So just be aware that you might have to turn up your volume, but it's a visual presentation anyway.
The symmetrical triangle pattern is formed by two intersecting trend lines of similar slope. These two lines are converging at a point called apex. The coiling of price that happens inside the triangle will eventually result in a breakout. The breakout can occur in any direction and the move is often as big as the base of the triangle. The ascending triangle pattern is easily recognized by a rising trend line intersecting with a flat resistance line. It is often regarded by traders as a bullish pattern because the price keeps bouncing off a resistance line that may eventually be broken. That descending triangle pattern is formed by a descending trend line intersecting with a flat support level. The repeated attempts of the sellers to push the price down can result in a breakdown through the support line. In all cases, the stop loss can be placed beyond the opposite trend line. The stop loss distance can be at least as big as the distance between the trend lines, measured at the moment of the breakout. A good place to place the take profit level is considered to be as far from the breakout point as the triangle base is wide. Choosing the take profit distance a little smaller than the base width, if the risk-reward ratio allows it, can increase the chances of price reaching it. These chart patterns have no predictive properties, but they may give hints about the forces involved in the market.
So as you can see, triangles give you a bunch of information once you can verify the breakout. Okay. And those formulas are standardized formulas for using where to put your stop loss, where to put your take profit, for you to be able to factor this in, especially to your risk reward trading decision and your money management decision. Now, there are, like I mentioned before, there's a handful of patterns or market structures. Let me pop up a little chart here for you. And I've got them put together on this chart right here called market structures. And these are the array of chart patterns. Now, there are some weird ones out there that some market guru came up with. But what you're looking at on your screen are all of the standard patterns. So there's not a zillion you have to learn. We have bull flags, bull pennants. We have ascending wedges, descending wedges, triple tops, double tops, triple bottoms, double bottoms. We have bear flags and bear pennants. Then we have the head and shoulders. We have a cup and handle. We have an expanding wedge. Okay, and then we have a upside down, a right side up, cup and handle, and a head and shoulder. But that's it. It's only a handful. Now we have wedges as well as we have rectangles. Okay, and to me, a wedge is just another triangle. Okay, it's just another different version of a triangle. The difference with a wedge, and we're going to look at it in a second, is that a wedge has two sloping support and resistance lines that are sloping in the same direction. Okay, whereas a triangle has two parallel sloping or one horizontal support and resistance line. So let me explain that again for you a little bit better. But we have what we call channels and rectangles. A channel is formed between a parallel support and resistance line. That means a channel means the support and resistance line are parallel. They descend at the same rate. And then we have channels and rectangles. Okay, a rectangle is a pattern formed between horizontal support and resistance lines, like you see here. And this is a channel. They're both sloping, but they're sloping at the same degree. So rectangles are channels are sometimes called flags and pennants, depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down. That's a mouthful, isn't it? Or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. It means to tell you that it's a bullish, it's bullish because it's giving you a bullish signal, but it's coming off of an uptrend. Wedges, on the other hand, and wedges are similar to triangles. I just call them triangles. I don't differentiate because many triangles don't come to that final apex before the breakout. The most common wedges are found as breakouts in the opposite direction of the wedge, okay, which is statistically true, but there's no way to format it into your trading. But we could have called this a triangle. We could have called that a triangle. So I just lump them all into triangles. You know, unless you become a real pattern expert, you don't need to know that. You don't need to verify the differences, and you don't need the difference of an ascending or descending triangle because we're waiting for the breakout. We're only going to respond to the breakout. So let me share a little presentation here for you that will show to you graphically again and hopefully better explain it. And uh-oh. Now, one of the most popular chart patterns, especially one that we hear about often, because the name kind of sticks with you, and you always see it in the financial news, and that's called the head and shoulders. Now, the head and shoulders is a very reliable indicator. It takes a while to unveil itself. It takes a while to actually tell you anything because it involves a lot of individual price action. But when it does, it is fairly reliable. It is considered a reversal pattern. And a head and shoulders will not only tell you the market's reversing, it'll actually give you the entry point and tell you how far to set your, once you've got your entry, how far you can set your target point to help you set your risk management and risk reward ratios. Now, head and shoulders is exactly how it is titled. It is the formation of the left and right shoulders and the head of a person. Now, you can go through the internet. You can go read all the literature out there. You'll find gurus who tell you that the head has to be this much percentage higher than the shoulders, and the shoulder needs to be this much and that much. And okay. That's all of them preaching. If you only think about a head and shoulders pattern being the formation of a human being, what you have is you have price. Now, a correct head and shoulders or an upside head and shoulders comes off of an uptrend. Price breaks through and you won't even notice it. It hits a resistance level and falls back down and either touches an existing support level or creates a support level, bounces off of that level and comes back up to hit a higher, it breaks above its prior resistance level to form a higher resistance level, but then falls back down to that support level. This forms what we call the neckline. It isn't until this point that you would have any idea that a head and shoulder pattern is developing. When it bounces off that neckline again, it moves back up to start forming that final right shoulder. Until this final shoulder is developed, there's absolutely nothing for you to do. Then when price falls down to that resistance level again, that support level again, it forms the right shoulder. When price then breaks the neckline in the formation of the right shoulder, it's giving you a sell signal. It's telling you that this prior uptrend is over and we've now moved to a downtrend. Now we have an inverse head and shoulders that tells you the exact opposite. It comes off of an uptrend, comes off of a downtrend and tells you that the downtrend is over and moving into an uptrend. Now, if you follow my philosophy that a head and shoulders depicts the head and shoulders of a human being, well, you know what? I have a short, squat neck with a long oval head. I have two big, high shoulders. Okay, that's me. The guy walking down the street has a very long neck. He's got a high left shoulder and his right shoulder is a little bit lower. He's still got a head and shoulders. So ultimately, the head and shoulders can be slightly different. There is no definitive rule. Now, there's people that try to give them to you, but there is no definitive rule of what the difference has to be between the top of the left shoulder and the formation of the head. Like I said, it's just like a human being. Some people have higher heads, some people have lower heads. Okay, you could be slightly hunched over. So the neckline could be slightly, but only slightly on an angle. The left shoulder could be a little bit higher than the right shoulder. It still has to go through this whole process of forming a left shoulder, a right shoulder, a head, and a neckline. Okay, so I think of it as just a human being. And I'm not going to sit here and calculate 9.7942% of the left shoulder to give me the head, because none of it tells you anything at all until you break through. And the fact is, trading is messy, because in my little chart right there, it was easy to see a head and shoulders, but in reality, this is what a price chart looks like. It's very hard to spot it. And if you start applying all of these complex rules, you'll never see it. But here, price moves up, forms the left shoulder, which we don't even know at this point is a shoulder. Comes back down, bounces off of this resistance, this support line, moves back up and breaks this previous resistance line to form. Again, we don't know anything about a head and shoulders formation yet. Comes back down and breaks below the neckline and starts forming the right shoulder. Bounces off of that support level and touches that resistance level and falls back down. Now we've got this weird person's head and shoulders, but it's a head and shoulders. At this point, we now have a sell opportunity. So let me pop up a chart here for you, because I've got it on a chart, because we actually have one that's forming right now in the marketplace. So let me pop up a chart here for you. Okay. Now, here we have a Bitcoin, a head and shoulders pattern forming. Okay. We have the head, the left shoulder, the right shoulder, and the left shoulder, the head, and the right shoulder. But we were predicting price to fall down to here. Price never came back and broke the support line to give us the confirmation that we have a sell. And what happened is price continued in its previous uptrend pattern. So we were looking at this point to get this confirmation. We did. Also, volume supports that. Okay, and what happened is the market continued upward. But it's not so easy to see that when it's happening. And this incorporated a lot of days of trading. Now, once we get the head and shoulders pattern and it's formed most of the right shoulder, the end of it, okay, and we're looking for the sell signal, which would happen when it broke the neckline after the formation, there are some calculations that we can apply to the marketplace. Because remember, in our filtration process, we're trying to filter out all the trades. Now we have a sell signal. Now we have to apply other pieces of information, other confirmation tools, like for sure volume. But we need other tools to filter this trade down, because now what we've gotten is we've gotten a reversal signal and a sell opportunity. Now let's put it through our little filters, decide if we can make that trade. But in order to calculate for our risk reward ratios and our risk management, we have this formula. It's not something I came up with, it's a market acceptable formula. And this is target equals the neckline, whatever the price is on the neckline when it breaks that neckline. It's the price right here minus the head, which is whatever price it was at the highest point and formed that head, minus the neckline. So if we say this neckline was, say, at 10, let's say the head was at 20, we would drop this into a formula that would be N, the neckline, 10, minus the head is 20, minus 10. So what he has, 20 minus 10 is 10. And 10 minus 10 gives us a 0. So our target line would be our 0 value. So now we can use this to set our risk reward ratio with our maximum risk, because our volatility is here at 20, and our target price being at 0, we can now drop that into our risk management to determine other things about this price. Or, we are setting our where our stop loss would have to be, not our risk, but where our stop loss would have to be. But for our reward ratio, we need to be able to estimate what our target price is to see what our risk would be. And we can do that also with this formula. Let me just clear this off here. Now, these aren't formulas, like I said, I came up with. If you search the internet and you just go to chart pattern, you'll find all kinds of little charts that have these same patterns on, not, with a set of examples. I'll show it to you in a second. And all of these standardized formulas, because every pattern has a standardized formula. It'll give you the open, it'll give you where to put your, as you noticed in our little triangle example, it gives you where to put your stop loss, where your profit level will be, what your entry level should be. So from these patterns, we also go over to multiple tops and bottoms, which are part of chart patterns. I pay no attention to double tops and double bottoms. To me, and to most CFD traders, are valueless because price hits these same prices over and over and over in a trading system. Making double tops is just hitting either the support line or the resistance line twice. It has no value to any of us. Now, a triple top starts to give us a little bit more information. Okay, I have a whole class in a strategy called what we call channel trading, which is finding this channel between the support and resistance lines and trading off of support and before resistance. But a triple bottom and triple top are fairly reliable patterns, because to get 3 of those fully developed is not so rare, but is not so unique. Triple tops and triple bottoms are reversal patterns that touch either the support or the resistance lines 3 times before reversing their trend. This is a stronger indicator of a trend change than a double top or bottom. Look for a strong initial trend and a significant breakout in order to confirm the reversal. So when we see a triple top and triple bottom, its value only occurs if it's coming off of a well-developed trend. So all chart patterns are only as reliable as the trend and the quality of the pattern. So an important measure of the quality of a pattern is the trend that precedes it. It does not matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. So in other words, if you have a very well-deformed trend and a chart pattern exists, it's very, very reliable. If you have a very weak initial trend where price is really all over the place, you see here we formed this beautiful wedge or this beautiful triangle. Here we could draw these support and resistance lines only because they hit this top peak and the bottom peak, and they formed a triangle, but the whole movement was really more or less random, and it was a very weak trend. So the quality of that pattern is not as reliable. Now, a pattern is said to have broken out once it has crossed either the support or the resistance line. Price does. Now remember, patterns do not give you directional clues. Patterns do not give you buy or sell signals, except with a head and shoulders. There's an inverse head and shoulders is coming off of one direction, or a regular upright head and shoulders is coming off of a different direction. So they're the only ones that before the breakout actually give you a directional signal. Everything else doesn't give you a signal or doesn't give you a clue to where it's going until it breaks out. So a pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction of the preceding trend, it is called a continuation pattern, or the trend is continuing on. Okay. If breakout is in the opposite direction, it's called a reversal pattern. So for example, a pattern described as a bullish reversal triangle would mean that is a bullish signal. That is, the breakout was through the resistance line and upward. Because it's a reversal pattern, that means the preceding trend was in the opposite direction of the breakout. So that was a preceding trend was bearish. So in other words, a bullish reversal triangle is telling you to a sell opportunity, a buy opportunity, and it's coming off of a downtrend. So that downtrend is reversing. So as I mentioned before, there are these charts all over the internet, which you see that will look just like this. I got this from the internet, which are the standard patterns or the standard market structures and how to use them for your stop loss, your entry, and your target point. Okay. And they all base on the apex, the width of the formation, and the bottom and the top of those support and resistance lines. Now, trading breakouts is best done when the prevailing market condition is either uptrending or range bound with price action approaching the upper edge of a range. Once the resistance level has been identified, volume should be monitored very closely. A long position trade setup occurs when price action approaches and decisively surpasses the resistance level. In other words, we have a very strong breakout, and volume supports that breakout. So chart patterns are a very interesting way to trade. Let me take you back over and we'll take a look at all those market structures again. But they occur very often in price movement, and they are fairly reliable as giving you some type of what price is doing and give you some way to interpret what price is doing. Because all you're trying to do is take some randomness out of the market movement and find a place where we can have some non-random movement or a chance to get an opportunity. And like I said, we're looking for something to tell us we have a long or short opportunity, and then we can drop it through all the filters to filter out whether it's a good trade or bad trade. And this is what patterns will do. They will help you give you reversals or continuations or point out buy or sell opportunities. But again, a triangle by itself is not a trading strategy. It's simply a piece of information that helps you then start your filter process. And on that note, I'm going to say goodnight to everybody. Wish you all the best, and we'll see you next week. Thank you very much, and have a great trading week. Bye now.